Stocks have struggled as of late amid concerns inflation is no longer cooling, and the Federal Reserve could ease back on interest rate cuts. For more on how investors can best play the markets within fixed income amid Fed uncertainty, let's welcome in Steve Laipply, BlackRock Global co-head of bond ETFs. Hey, Steve, it's good to see you.
Hey, Julie, thanks for having me.
So what's your base case at this point? I mean, we've got folks now sort of all over the map when it comes to how many rate cuts are expected this year.
Yeah, and you saw the dramatic shift over the last couple of months. I mean, we kind of went into last year, at one point, I think we were as high as over 6 cuts, and now we're down to under 2. So depending on which way the front end of the curve's moving, we're still showing a cut by November, but then, after that, it's unclear if you're going to get another one, going into the end of the year, early part of next year. So eventually, the expectation is that policy will ease, but that whole idea of multiple cuts this year certainly seems to have been pushed back. And Fed speakers the last few days have done nothing to dissuade anybody from thinking that.
Steve, I'm curious how investor portfolios have been challenged this year, given the action we've seen both in the stock market, where things have been quite buoyant. It always makes it less exciting to get 3 or 5% return on your fixed income, and also the shifts we've seen. You mentioned the front end of the curve, the dramatic move we saw last week there. Just how that has challenged the setup for the fixed income side of investor portfolios.
Yeah, and I think this is tricky because, as you know, we've been vocal about, starting to move off the sidelines, starting to right-size your fixed income allocation. Most investors using our data are fairly under-allocated fixed income. And it's no surprise because, we embarked on probably the strongest tightening cycle in 40 years. So it's understandable that investors would be somewhat guarded here. But we do think that it's time to start moving out of cash and back into fixed income. Now, yes, it's been uneven. It's interesting. Last year is a good case in point. And so last year, going into the fall all the way up until Halloween, you had really tough sledding in fixed income. You had negative returns. But by the end of the year, that had shifted dramatically. And so what we're telling investors is that it's probably going to be almost impossible to time the peak in rates. It's time to start moving. You dollar cost average in stocks, you should start dollar cost averaging in bonds as well, so you're set up when the economy normalizes and policy normalizes.
So Steve, if people are under allocated to fixed income, what's the proper allocation for fixed income? I mean, are we talking 60-40 here, or how should people think about it?
Yeah, and I think this is where investors do have to have at least some views. So we recently laid out 3 scenarios, and they're pretty obvious ones. But if you believe in the soft landing, you want to start moving back out into broad fixed income. So think AGG, IUSB. Also in that scenario, you would want to do, potentially high yield, some EM. I mean, just sort of your overall broad diversified fixed income basket if you have confidence in that soft landing. If you have concerns that the Fed is still very much in play here, and then inflation is going to be sticky and potentially could, even sort of keep kind of popping up a little bit higher. There are still plays you can do in fixed income at the front end of the curve. So as an example, short-dated TIPS, STIP would be a good way to do that. And then, of course, you have the very short-dated Treasury exposures, SGov as an example, TFLO, things like that. And then finally, for a hard landing, which is still talked about. And that's the trade where, everybody thinks things are fine. We have to be higher for longer. But all of a sudden, things start moving very, very rapidly and the data starts deteriorating. Then, of course, you would want to be in longer duration. And we all know what those tickers are. You could have TLT or IGLB for long dated investment grade, things like that to try to insulate your portfolio from a diversification standpoint if we do get that hard landing eventually.
And Steve, maybe stepping back from this conversation about, what's the Fed going to do over the next 6 months, et cetera. I'm curious from a portfolio standpoint, what the competition has been for fixed income from things like, not only private equity, alts, private credit. The landscape has changed for investors so much in the last 15 years. What's that conversation about what role fixed income specifically plays in there relative to a really large menu for folks that has this this safer profile, let's say, something that seems to be a fixed return. It's not a fixed income, but you know what I'm saying.
Yeah, and so this is the discussion right now, right? If you go back 5 years, in order to get decent high single digit yields, you had to be in high yield and beyond. You had to be in private credit. You had to be in alts or liquids, really to stretch that yield. If you go, before we got into this inflationary period, so pre-2020, yields right now, believe it or not, are higher than they were in 2004 across the board. So if you look at all fixed income asset classes, which with the exception of high yield, depending on when you measure it, just because of where credit spreads can be, in a given week. But broadly speaking, yields available in fixed income today are higher than they were 20 years ago. That affords tremendous opportunity and allows you, in our view, to get a more balanced portfolio. You should have all of the above in a diversified way, but you don't need to be overly reliant on illiquid product in order to get that yield now. As you know, you can get 5% in the front end, but we think you should sort of diversify away from that and branch out, an intermediate part of the curve in other asset classes.